Well, good morning, everyone. I see a lot of familiar faces out there, so good to see you all again. For those who don't know me, my name is Briggeman. I'm a professor in the Department of Agricultural Economics here at Kansas State University, and also I'm the director of the Arthur Capper Cooperative Center. With that, I do a lot of work with farmer co-ops, so grain marketing farm supply co-ops. That's the majority portion of my extension appointment and who I work a lot with. But I have another aspect to my extension programming, and that's talking about the macroeconomy. As Rich mentioned before, I came to K-State. I worked for the Federal Reserve Bank of Kansas City, actually in the Omaha branch. So we have a meeting that starts later this afternoon there, so I got to head up to there for that. But I'm going to share some of the stuff that I did at the Fed. I was there over the financial crisis, trying to make sense of what's going on in the macroeconomy, monetary policy, fiscal policy. What does it mean for us in agriculture, rural America today? So I'm going to share some of those thoughts that I have with you because there's one or two things going on in the macroeconomy, that government shutdown, all this stuff that's going on. I will also say this because it's really great doing a Fed talk when you don't work at the Fed. It is fantastic because I can give you my opinion. All right, I may be very wrong, but I can give you my opinion. So I'm going to share some thoughts with you all, and let's just get started off on the theme of something that would not be approved if I worked at the Fed. This is the slide that I wanted to show just to kind of talk about the macroeconomy. Like, what does this mean for us? There are so many uncertainties, so many things that are out there. Trying to make sense of it all is difficult. It's very, very difficult. I have a lot more questions than I have, thoughts about where are we going to go? What are we going to do? It's just an interesting time. Now, with that said, I am going to share some thoughts about what's going on and what does this all mean for us as agricultural lenders, right? How can we work with our customers in a way to kind of navigate the uncertainty that we have out there today? So you do have my slides. I do throw in some extra slides like this. Again, just to kind of emphasize some points about as we go through this macro outlook and what does it mean for us in agriculture. So to start off any macro talk is just how are we doing as an economy, right? So let's look at our measure of GDP, so the value of the goods and services that we produce, our gross domestic product, and in particular look at it on an annualized change basis quarterly. And actually the latest numbers that we had come in for quarter two were quite good, at 3%. 3% growth is excellent for a quarter. Anytime we have growth above 2.5%, that's a signal that the economy is doing very well, that we're seeing, the manufacturing industry, we're adding jobs, businesses are kind of taking off. The economy is moving along very well. But when we unpack how we got to this 3%, it's a little bit of a different story. In particular, if we break it down into the different components of GDP, so if we look at consumption, investment, net exports, and government spending, we can kind of see what's going on with the economy and how we are reacting in our current environment. So for quarter one, if we look at that, we see a big gain in investments, right? A lot of investments, and we had a tremendous drop in net exports to where we had very little growth. Well, a lot of that is just reactions to the tariff policies that businesses knew that were coming. Pulling investments ahead to get ahead of those tariffs and potential added costs, and then also importing a great deal, stocking the shelves. Quarter two, what we saw was just kind of a flip of that, right? We saw investments really fall down, imports dropped dramatically, which actually led to net exports adding in really the story of driving that 3% growth. So a lot of it is just merely reacting to tariff policy, right? So this 3%, I would agree with economists here. Going forward, we really don't know what's going to happen to the economy. There's a lot of questions about it. When you see forecasts that are around 0%, basically that's economists saying we don't know. One thing though that is interesting to pay attention to for going forward, and I want to point to a pretty big risk that we're exposed to in our economy, and it goes to consumption. Consumption drives our GDP, really. I mean, at the end of the day, we are a nation of consumers. Roughly 70% of our consumption 70% of our GDP comes from consumption. And we can see that very clearly in this graph here. When you have the COVID pandemic and you shut down an economy and tell a nation of consumers to sit at home on Zoom and don't spend your money, that hurts, right? We had an annualized, negative 30% right in the middle of the pandemic. But when we started to open back up, we were excited to get outside, get outdoors. We started spending our money, and then we had a 35% growth. We are a nation of consumers. But where that consumption is coming from over time to where we are at today is very concerning to me. So what I have here is I just plotted the total GDP breakdown. So again, consumption, net exports, investment, and government spending, just plotted it over time in total dollar amounts so that we could see the evolution of it. Back in 1959, our economy was roughly $5 trillion, and about 60% of that GDP, total GDP, came from consumption. You can see as our economy has changed, we hit a period of pretty rapid growth. Of course, you can see the Great Recession here, that little dip, and then the pandemic, another significant dip, but sharp snapback. We grew to a point where now that blue area represents about 70% of our total consumption. Moody's Analytics went a little bit deeper, dug into that 70% number, and discovered that there are 10% of US households that make up half of all consumption in the United States. Those households that earn more than $200,000 a year represent 50% of consumption. Said another way, that's about 35% of our overall $30 trillion economy comes from 10% of our households. I used to be a lender before I went on for my PhD, worked for Farm Credit. One of the things we talked a lot about, especially with agribusinesses we are working with, is concentration risk. Doesn't this sound like concentration risk to you? I mean, if we have any hiccup at all with these 10%, that could really bring down sales, really hurt things. Because if you think about the other 90%, it's really tough right now. So my favorite place to go eat in Garden City is Tequila's. You ever eaten at Tequila's restaurant? Guy back there is shaking his head. Love it, love it. My favorite Mexican food in the entire state of Kansas. I look forward to going to Garden City. I just cannot wait because I can go eat at Tequila's. Although I did talk to some Garden City friends of mine, and they said, you need to go try some other Mexican restaurants in Garden City. There's maybe a few other spots that are better. But anyway, sat down, always get the Acapulco plate, and I was shocked to see that it was $21.99. Always, for years, it had been pegged at $15.99. I mean, that's pretty significant price jump. So our away from home spending, right, it's a lot more expensive to go out to eat. It's a lot more expensive to go buy groceries. We maybe really haven't felt it too much at the pump, the gas pump right now, but for the other 90%, it's difficult right now, right? There's a lot of retrenching and trying to figure out where we're going to go. Right. And I know Glenn, when he does his meat demand monitor, he's going to emphasize some of that with you all too. But it all kind of flows in and affects our macroeconomy outlook. There's a concentration risk that's out there, and it is concerning. Now, for us in ag, in any macro talk, this is the question that I think we have to think about. Where are interest rates going? That has the most direct impact to us, whether that's through trade, exports, the value of the dollar, what we pay on interest costs, because I'm sure all of you who are working with farmers right now are having discussions of, do we need to term out some of this debt or tap into the equity that we have in our land in order to get through, to build up some working capital to get us through this difficult time? Where's interest rates going? Of course, when we think about interest rates and its connection to our most valuable asset, there are some correlation that goes along with that. There's a connection with real cropland values. So here I have Kansas real cropland values plotted over time. And on the graph on the right, you can see its connection with real interest rates. And in particular, when real interest rates tend to go down, stay especially in negative territory, it provides some upward momentum for land values to rise. But when they go up and we see them pop significantly, like they did in the 80s, right, that's timing with some pretty turbulent negative times. We saw land values collapse. Today, interest rates are elevated. We've seen the rates come up, and we've seen land values kind of start to moderate. I'm not anticipating a collapse in land values, but I definitely think we're going to see a cooling of it and even maybe some coming off. These farm income outlooks right now, elevated interest rates, it's going to be, I think, a pretty difficult time. But there's this connection with interest rates. So where are interest rates going? A lot of it goes back to what the Fed is seeing. What is the Fed doing? What is the Fed following, right? Here most recently, they lowered the Fed funds rate, the rate that banks loan to each other overnight. The most clear way that the Fed can help guide the economy, they're seeing some challenges. So they lowered it 25 basis points, right? Biggest challenge is the labor market softening. The August report came out and said we only gained 22,000 jobs. And we had, a lot of questions around that too, especially where those jobs were being generated. Not from industries that we need to see growth in order to really kind of help the economy along. Not in manufacturing, not in business services. We're seeing a big pullback. And in fact, I just saw in the Wall Street Journal this morning an early estimate on the September jobs report, which I don't think we're going to get on Friday because the government is shut down. At least the early estimate is that the economy lost 32,000 jobs. And I think that makes sense to me. So there's a softening within the labor market. That's concerning to us because, again, 70% of our GDP comes from consumption. If we start really retrenching, and especially those 10% households start to retrench, that could move us towards a recession. Inflation is sticky. It's still around. It sets at 2.9%. It has not backed off. You'll see a chart here in a little bit. It's, with housing, insurance, other things that just don't adjust down as quickly, they're remaining elevated, right? So we still have inflation coming off of the pandemic. Is this growth sustainable? Well, I just kind of made the case that I'm not sure that it is. I would expect Q3 to come down pretty significantly. Won't be the 3%. Tariffs, what are they going to do? What's the full impact that we're going to have from them? Will businesses pass them through, right? That added cost through higher prices. A lot of questions. Again, the emoji of, we've never been in this before. So, at least in this modern economy, what does it mean for us? Market does expect the Fed to lower rates again in October, and I think that's going to happen. The question is going to be how much, is it 25 basis points, 50? I think this Fed will also be mindful of inflation. So I think they'll probably lower it to about 25 basis points. The market expects inflation to be under control at 2.5%. The question is, where is the Fed going? I think they're heading to 3% with the Fed funds rate, probably around next year, as long as the economy can keep moving. I have a graph at the end that I'll show where I kind of have that guidance. It's basically from the FOMC's projections on the dot plot, showing that the midpoint is about 3%. That's their normalized, what they would call a normal interest rate that they want to head to. So now, of course, if we move into recession, that'll all change, right? I mean, they'll start lowering rates very rapidly, probably go back to quantitative easing, try to get us out of this. So anyway, it really kind of boils down to what the Fed is going to do. And the Fed, what they're guided by is their dual mandate of full employment and stable prices. So full employment, one way to measure that is the unemployment rate. Fed has a target of 4.2%. And you can see in this graph that orange line, headed towards that. It's been hovering around that 4.2% mark for quite some time. We have seen some stabilization within the labor market coming more into balance. You can see in this graph here, just looking at the unemployed to job openings ratio. When that ratio is at 1, the job, it's in balance. When it's below 1, we have a tight labor market, meaning employers are having to raise wages in order to get people to enter into the labor market and come to work. We just went through a period of that, right? If you remember coming off of the pandemic, we had to keep raising wages just to get people to come to work. It was a tight labor market. Well, we come in more into balance, but now it's softening again. So if we have this, unemployment ratio pop up again, right, that's when we start to have some real issues within the labor market. The other side is stable prices. So stable prices, looking at the Fed's preferred measure, the personal consumer or consumption expenditure index, the core. So strip out things that are very volatile like fuel, energy, food, things that fluctuate quite a bit. And look at that more stable measure. We've been pretty stable right around that 2.5% mark. We've started to see an uptick of that here lately to 2.9, and the unemployment rate has ticked up a little bit. I think I've seen a lot of articles coming out asking, talking about stagflation. Could we have a stagflationary environment? I have some slides here a little bit later to draw some, correlations, or at least look back what the last stagflation period we had in the 70s, what's similar today. So I'll save that for a little bit here, but there's some concerns about the overall economy. The other side on labor is just what we have going on within the US as far as fertility rates, right? We're down below 2 births per woman, so we're below our replacement rate, right? And there are questions about our workforce, our just population growth. It's starting to stagnate, right? There's an end. We can see it here in the data. We've been trending down for a while now. So where are we going to get this labor? Well, people coming into this country, right? We look at the data here of US employment levels by where you were born, and we see those that were born in another country is really come down. And into today, in 2025, it's almost zero. So if we tie these two things together, where's our labor going to come from? What are we going to do? I do a lot of work with cooperatives, and the number one thing that they all talk about is talent. And when you're in Western Kansas, it's not so much just talent that you need, but you need people, right? We have to have people. I raise this that we need to do something as far as immigration goes, right? We need to find ways to have people come into this country legally, because the future of our economy depends on it. I mean, that's what this data shows to me. And I hope we can find a way in order to do that in a way that brings folks in legally to where we have that labor force that we will need not only in agriculture, but in the US, right? The other thing about population within the US, it's not just the US. Anybody in here read the work at terrainag.com or Terrain Ag, The Big Shrink? If you have not, do it. Go to terrainag.com, pull down their work on the Big Shrink. I have some of it shown here, this bottom right-hand graph. The punchline for it all is if you look at our major trading partners, in particular Asia, they're past their peak population. In fact, it's starting to come down. When I came into this role as Capper Center director and going to different co-op conferences in 2011, for probably 8 years, we always had a speaker. Every single conference I went to, how are we going to feed all these people? Where are we going to go? How are we going to do this? We got to grow more, fence row to fence row, do everything that we, ship out, build shuttle loaders. We got to do all this stuff. Now, that's starting to change. Because when we look at the population, are they going to be that source of demand? Source of demand, when I look at this graph, here in Africa. And in fact, if you drill down to a lot of those data that shows the population growth back in 2011, 2012, when we're hearing all those talks, a lot of it was coming from inner part of Africa. Well, how are we going to trade there? How are we going to get the product there? And then if we get the product there, where's it going to end up? What are we going to do? So these trade markets, and Guy is here, and I'll let Guy handle all the trade questions. He's much better at it than I am. I don't know. There's some real questions for us in agriculture about what is that future export market even going to look like? Forget tariffs, right? We can get them out. Where are they going to go, right? Where's that product going to go? But anyway, plug for Terrain Ag. Go take a look at their work on the Big Shrink. It's pretty good. Tariff rates, of course, we're here. These are the announced rates. They're probably already wrong. I don't know. Did they change? But just looking at where we're at, on tariffs, that certainly has an impact on us when it comes to trade. Where are we going to go with these products? Is there going to be retaliation? Where is this path? I have more questions than I have answers. when it comes to tariff policy. But right now, it looks to be a challenge for us in agriculture. At the broader macroeconomy, looking at manufacturing, Philadelphia Fed, they do a manufacturing survey, does a nice job of surveying manufacturers just to get a sense of what they're seeing. And what they're reporting is elevated prices, higher than what they've seen before. And then the graph on here on the bottom, we're seeing a reduction in those CapEx expenditures. So we're seeing a retrenchment. The question is, will these higher prices be passed through, right? And will that add more to inflation? What is going to occur with that? Certainly, we are in a period of uncertainty. This is an index that looks at global economic policy uncertainty across the world. And you can see here that in April of 2025, whenever all the tariffs were announced, there was a lot of uncertainty. It has come back down, but with the government shutdown, will that add more uncertainty to this? Could we see it go up again? And how do businesses react when they have uncertainty? It's pull back, wait and see. What are we going to do? We're in a period where there's a lot of questions that are out there. You can see it's elevated even still at about pandemic levels. So I said I was going to talk a bit about stagflation. I started asking this question probably almost a year and a half ago. Actually, in this room, I was talking about it. What happened back in the 70s and what is similar today, right? Are there some things that, like we're not going to have exactly what we had in the 70s, but are there some things that kind of, rhyme with what we're seeing today? So I'm just going to walk through, not saying that, hey, this is an indication that we're moving into stagflation, just more trying to make sense of what that environment would look like. Just real quick, stagflation, the stag part means a stagnant economy. So the US economy is moving into is in a recession. We see GDP declining. And then the inflation, we're in an inflationary environment where inflation is going up. That typically does not happen. Usually if we have inflation, we have growth, right? And the economy is going. But if we have the economy going down, we have inflation coming back down. So it's a unique period where the two things are moving opposite of each other. The fix to it is what scares everybody. Because Paul Volcker, the chairman of the Fed at the time, who was put in by Jimmy Carter to fix it, he fixed it and sent us right into a really severe recession. That was when interest rates went up to 20%. And that was the fix to get rid of the inflation, right? So what, could it rear its ugly head? Okay, so the first point, leading into the 70s, they had pretty tremendous government budget deficits. Okay, do we have them today? Yes. We have a lot of debt spending? Yes. I don't think I have to show you a graph to prove this point, but I'm going to show it to you anyway. We have on the left looking at, and this was in 2024, coming from the Congressional Budget Office, looking at our outlays above the revenue we're bringing in. So we're deficit spending, right? We're spending more than what we're collecting. And of course, that means debt has to go up. So debt, graph on the right, debt held by the public, we're above on a debt to GDP ratio at 100%, right? The last time we were there was, funding the war, the World War II effort. We were fighting the pandemic war, right? We're fighting a virus, so we had debt there, but now we're just, what are we fighting, right? We're fighting these deficit spending that we have, seeing debt that's projected to rise to 120%, but things are a little different now. We do have the One Big Beautiful Bill Act, OB3, right? But what impact is that going to have? So I haven't spent a ton of time diving into OB3, doing economic modeling. So I'm just going to present two, maybe views, bless you, two views on the impact that this will have on budget deficits and the economy. On the left, we have the Congressional Budget Office. They went through and did an estimate. They expect a 0.5% GDP increase over 10 years, reduce costs by $124 billion, but there will be higher deficit spending because of interest payments, because debt is expected to rise to 124%. That's CBO. The Council of Economic Advisors, their anticipation is about 5% GDP increase coming down to 2.7, reduce deficits by $4.5 trillion. And then public debt under their worst case scenario going down to 100%. So a very different view of what OB3 could happen. Now, I don't know. Like I said, I haven't done the modeling. Here are two views. Probably the truth is it's hopefully somewhere in the middle, right? Hopefully it's over here on the right. That's what I hope happens, that we can just eliminate deficits and have debt come down and have, tremendous growth. But we'll just have to see and monitor where it's going to go from here. The other thing, and I think this ties to what happened early this morning, as well as for us in this room when we think about farm real estate interest rates. What's going to happen to 10-year treasuries? What path is it going to go? Just so 10-year treasuries tracks almost exactly with farm real estate interest rates. And that makes sense, right? Like they're going to use this as a way to price and build in a premium for those farm real estate interest rates. I don't have a graph in here for this, but it tracks almost exactly with it. It's a little bit above, probably about 1.5%, 2% above. So if we look here over time, right, we had a period where interest rates were exceptionally low coming off of the Great Recession. We're all afraid of this, right, of going back to the 1980s and seeing that 15% interest rates. But we've come back up, right? We're sitting just below 5% on US Treasuries. But if you drill down into why is that being priced, part of what's going on right now is we are having to offer higher yields, higher rates in order to get an auction in order to move these 10-year treasuries. And part of the reason for that, people who are buying these treasuries, whether individuals, entities, governments, foreign governments, needs to be compensated for the default risk that they're experiencing. One way to measure that is to look at the term premium on a 10-year zero coupon bond. That has elevated, right? We're down around zero for a long time, even in a negative territory. Basically, when this goes into negative, it means we're the best of the worst, right? Everybody else looks like they're going to default. Well, we might as well, let's go to the US and just grate our teeth and get through it. But here today, that's come up to about 0.5%, right? So again, that's just compensation the market needs in order to buy US Treasuries. Not that long ago in the 90s, we were up around 2.5%. So could we add another 2% to 10-year Treasuries, add another 2% just on that for farm real estate? Forget about any sort of risk that's going on in agriculture. Sure, I think we could do that. And today, with the government shutdown, could that add to this, right? The uncertainty that's going on, like, will we get funding figured out? Will we continue to pay? Back in 2018, this was the last time we had a government shutdown, right? The longest government shutdown of 34 days. The term premium went up about 0.5% over that period of time. If we look back, the other long government shutdown, I think it was 21 days, was back in 1996, 95, 96. It went up 1%. So how long this government shutdown exists could have real impacts on what our farm real estate interest rates are going to do. I mean, you can paint a picture real quick that we could add 1% just right there, right? Something that I would monitor, keep track of, but when I see what's going on, these are things that I kind of want to look at, try to have an understanding of. The other thing that happened during that period of time is we moved off the gold standard. Bretton Woods, we went to a fiat currency system. The currency system that we have today, monetary policy changed pretty significantly. And in fact, a lot of confidence in the Fed went away. You mean we're no longer tied to the gold, the gold standard? What does that mean for us? Like, how is that going to change? So today, being in zero-bound interest rates, quantitative easing, monetary policy has changed pretty significantly. One way to show that is through the Fed's balance sheet. So this graph shows the asset side of the Fed's balance sheet. First thing that jumps out to me is just the scale of it, how big it is, right? When I worked at the Fed, right before the financial crisis, we had $850 billion on the balance sheet. Today, it expanded all the way up to $9 trillion. Now, one thing I didn't say in my intro is I'm a farm kid from Iuka, Kansas. Anybody here know where Iuka is at? Oh yeah, from Iuka, right? I have no idea what $1 trillion looks like. So let's go through a little thought exercise real quick. Again, this is not non-Fed approved portion of my presentation. This is a $100 bill. We can put it in our pocket. Shoot, we can package them together and have 10,000. We could have it in our pocket right now. Nobody would know. $1 million, put a person in here for scale, right? $1 million, that's a lot of money, but you could put it in a backpack, grocery sack, walk around. 100 million, if you have $100 million on you, people know you have 100 million, right? Because you got to have a forklift to move this thing around. Here's $1 billion, right? With this, here's $1 trillion. See the person down here in the bottom corner? How small they are? That's a warehouse of cash, right? $1 trillion. And the Fed has moved it to 9 and now has brought it back down to 6. This has implications that I don't think we fully know or understand. What is the impact on the economy? How do we unwind this? Because right now, right, the Fed chose an industry that is a winner. They chose the real estate industry. The red area shows mortgage-backed securities. At its peak, here in 2009, they were the only ones buying mortgage-backed securities at the time. And then here at the peak, when we got here to about 2022, they represented about 23% of the overall mortgage-backed market. That sounds like a lot of liquidity being provided into a particular industry. And now it's coming down. And now we have questions about real estate, home rates, what's going to go on. Is this right? What did we do? And then also the orange area, the Fed is buying US Treasuries. Well, that's called monetizing the debt. Anytime a central bank buys its government's debt, it leads to inflation. The Fed was trying to create inflation coming off of the Great Recession, right? Now, they're part of the story. I'm not saying the inflation we have now is everything tied to the Fed, but it's part of it. What does this mean for us going forward? I bring this up because monetary policy, how we navigate it, it's very different. And if we have if the market loses confidence in the Fed, that's not good, right? That could be pretty significant, be to our detriment. One thing we haven't seen this time around is crude oil, right? Crude oil prices are down, right? Or relatively down to what we had in the 70s. But if we have continued problems in Middle East, if we have any sort of disruption there, that could be pretty significant for us, right? Could lead to some real challenges with the overall economy. Could be something that could move us into a stagflation type environment. Like I said before, the Fed, is at least being trusted right now at the moment, right? We haven't seen that. We need to continue to have that. The market needs to have faith in the Fed. But back then they did have that, and we had inflation expectations were no longer anchored, right? The market felt the Fed could not meet their dual mandate. And then, of course, a wage cost spiral. I'm not going to spend a whole lot of time on that because I don't want to eat too much into Greg's time. I want to leave time for questions. So the Fed funds rate, like I said, it's come down, right? We've seen a real rapid rise in order to get inflation under control. Now the Fed funds rate is coming down. It's going to be down again another 25 basis points. We're all afraid of what happened in the late 70s, early 80s, right? Where interest rates got up to around 20%. That's what we want to avoid. But if we see where the Fed is going, I do feel the Fed is trying to normalize interest rates, right? Move them back down to what is normal for them. This is the Federal Open Market Committee's projections, the midpoint projection where they see the Fed funds rate in 3 years, i.e. what is that long run stable Fed funds rate. And it's right at about 3%, has been right at about 3% for a long time when we were in this low zero bound environment. I show this graph historical because back in 2012, when they reported it, it was always 4%. That was what it was normal, expected normal before the financial crisis. I bring up this point that 4% to 3%, we're not out of a low interest rate environment, right? I mean, we're still in it. The Fed has even built it into what their expectations are that we're going to have lower rates going forward. So the impact, zero bound interest rates, again, hitting that, I think definitely could happen, right? Fed has built that into where we're in a lower rate environment than what we were in the past. So some of the key takeaways, thinking about high interest rates, what's going to happen to farm real estate rates. We might get some relief on short-term rates, right? With the Fed lowering rates, maybe we'll see a little bit of relief there, but I don't know if we're going to see that relief on the farm real estate side, especially here during this period of pretty significant uncertainty, what's going on. Looking at that 10-year treasury. So the thing that I would ask, right, is, well, my dad always says this to me when we have these conversations. He's like, Brian, that's great. We're talking the macroeconomy and interest rates. And he always says, so what? I'm a farmer. Like, what the heck do I do? And I'm like, well, that's probably I should just do my talk on that, right? Like, what does he do? Well, I do have a slide on it is control what you can control. The boring stuff, as you work with your customers and work with your farmer borrowers, is probably even more important now as we start making planting decisions for 2026. What are we going to do? Create a budget. Stress it. What happens if we have input prices go up? What happens if your landlord adjusts their cash rents up? What happens if maybe you lose some ground? Stress the budget that you put together. And then also, I always tell farmers, realize that first budget you put together, that's your first wrong budget, right? Have the discipline to go back and update through time. And that is not fun to do. It's boring. I understand. I wish I had a silver bullet to fix it, but that's probably one of the most important things that farmers need to be doing. So working with their customers on budgeting and stressing it. And then we got to build balance sheet, right? Liquidity, 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 liquidity. I know probably many of you are having conversations of terming out some debt, tapping into that equity, building up liquidity that way, which maybe is fine to get us through this period of, uncertainty. But going forward, recognize the importance of it. How can we build it? You're going to have opportunities to add working capital to your business. Find ways to continue to do that. Using debt wisely is very important. Working closely with you all as lenders, that relationship is going to be more important now than maybe for going back quite some time, right? We got to work together on this. And then efficiency, operational efficiency, pour over your operation. How can we extract? How can we control costs? Knowing your break-evens, very important. And if we can do all of these things, there are going to be opportunities out there, right? We got to find ways in order to jump on those. Okay, so that's what I had for prepared remarks. Wanted to leave some time here for questions. And yeah, Robin, if you can, pass that around, or I can also repeat too if you can't get to it enough time.
Yeah, if you have a question, raise your hand. I'll bring you the microphone so those online can hear the question.
I know you.
So on one of your earlier slides, you talked about consumption and how it's really concentrated in the top, 10 to 20% of consumers.
Mm-hmm.
And you talked about there's risks with that because there could be hiccups. What are some of the hiccups that could impact that consumption? And is that going to, move us towards a recession, or kind of what would need to move the needle there to really have an impact on the economy?
Yeah. So what would happen for those top 10%? Well, if we start having those are white collar jobs, right? If we start seeing companies adjust and say, no, we need to start laying off like white collar workers, that really could hurt them, right, to come off. Also, if the outlook just gets to a point where they're like, you know what, we need to stop spending as much as we are. We need to start pulling back in. Because right now, I think during, the coming off the pandemic, there was a lot of pandemic spending. We've seen, their savings have gone down. Everybody's savings has gone down. I think from maybe not as much for that group, but those would be things that could push them over, right? If they decide to, hey, we have to pull back. So, losing a job, and then also too starting to see, just their outlook change. And I haven't seen any measures that would focus in on this group and where they see, but you look at the Michigan Consumer Sentiment Index, it's very low right now.
Yes, I appreciate you talking about a budget, but I know a lot of really good managers of farmers from throughout the country that have tightened down, have gone through their budget, but now we have there was no profit in these markets So they've hung on to their corn and their soybeans and did not price ahead,
Oh, boy.
even at a loss. That's
Mhm.
the reason they didn't price ahead. They were losing money. They thought, well, let's just watch this drought or supposed drought coming in. So they're looking at all this. And what I see is that those budgets are as tight as they can possibly be with these managers. It's the price. We
Mhm.
have the markets came out yesterday with the report, or the USDA came out that there was more farmers that held wheat this year and then in storage on farm and in the elevators waiting for that.
Yeah.
And today it's down another 6 cents. So the budgets, we're at that brink. And so I understand the budgets, but I think they're there. I just know a lot of good farmers.
Yeah.
And so I appreciate where you're coming from on the budget, but what's your thoughts on prices? I mean, I know this is past, you have other guys from K-State
Yeah.
gals that can talk about that.
Yeah.
So anyway, that's where I'm at on the budget.
Well, I know Dan O'Brien is going to address, the crop outlook and looking at prices. The one comment that I would make on this, and this is what I hear from co-op managers throughout, is we're going to have a huge crop come in. Where the heck is it going to go? The ground piles can only be there for so long. Where are these new markets going to be? Because will China come and buy? So the comment that I would have, and this is probably better for Guy and for Dan to address, is we have to have markets. It's great to have some government payments to help get us through this time, but at the end of the day, we need markets in order to sell this tremendous crop we're going to raise, and livestock too, right? Yeah, I don't. One thing I will add, I guess I share a personal story, and one gentleman in Garden City said, "Hey, you might need to add a bullet point to your last slide." Yeah, here. Are there new crop opportunities out there, right? Are there other ways that we can, with biotechnology and other markets and opportunities, do we need to start shifting? All right, personal story, my dad, he does this. My dad farmed and got through the 80s, and now my younger brother's coming into the operation, and he's turning a lot over to him. And David is very entrepreneurial. He's his own person. He said, I don't know if I want to plant just all the normal crops. So we've actually planted 600 acres on our farm of hemp fiber. 600 acres. And I told David, when he asked me about this, I said, okay, number one, you can plant hemp for fiber, right, for textile and produce, but you better make darn sure you have a good contract in place, because the market after that is abysmal. You're definitely not going to cover your cost of production. But in our area, there is a pretty good contract in place. The hemp bales are going down to Panda in Wichita Falls for processing. In fact, I think they're loading semi-trucks right now. So this is an opportunity when Dad and David are sitting down looking at the 2026. They're asking the question, should we plant any acres of wheat? Because if we put in wheat, we know we're going to lose money. And at the end of the day, it's about making money, right? And they're actually having conversations of, well, if we can get the contracts, let's increase the hemp fiber that we plant and move from there. So I share personal story about what my family farm is going through and what they're working on and trying to, how do we get through this? How do we look at this budget and it looks like terrible? Well, there are alternatives. Yeah.
We've got one online. A farmer's balance sheet feels like it is more and more influenced by actual and potential government payments, ECAP, SDRP, et cetera. How should the industry feel about including them into the plan? Should we expect more or less government support going forward?
So Brian Briggeman's opinion, and my colleagues might disagree with me, and that's fine. I wouldn't build that into the forecast at all. I would leave it off. I'm way too conservative on that. Politicians will say that. They'll probably, more than likely, send out some sort of government payments, but if we put a plan together, put a financial statement together on the hope that the government will make this thing work, I think that's a slippery slope to go down. I think a lot of the good managers that you talked about, sir, with, you know, like I know my dad, he doesn't anticipate it. And that's, you know, my brother, he doesn't anticipate it. It's like, no, if we get it, we get it. That's my opinion. Yeah.
Last question here.
So this is more of a comment than a question, just on kind of following up on the remarks about, you know, crop budgeting and budgeting for our profit. I think one of the things that might be beneficial for not just farmers, but also for lenders and farm managers to consider is whenever you're looking at the whole of a farm, the entirety of the operation holistically, sometimes there's just going to be years where you have to budget for a loss on particular enterprises. But the goal in that case is spreading out your risk, managing your risk through diversification of enterprises, which I think, Brian, you were talking about. And it might not necessarily even be that, oh, we have to plant 600 acres of hemp in order to have a different market opportunity. It could be that we're budgeting our corn at a loss, our wheat at a loss, our beans at a loss this year, but we are budgeting our beef, you know, at a profit and making sure that, and the other thing is, not every year is going to be a profitable year for the entire farm. It's kind of it's more than just building a budget, it's building a system of budgeting, you know, for the long term.
Just a quick response. I agree, right? I mean, that's kind of to the point. So thank you, Luke, for that. One other comment on hemp. If you have people who decide to plant it, get ready for some talk in your with your neighbors, and get ready for a lot of questions from the UPS driver and FedEx who's coming up to give you your Amazon packages, because they're going to look at that a little funny, right? But anyway, so thank you all very much. Sorry I have to get going, but I hope you enjoy the rest of your day. Thank you.
Thanks, Brian.